In this chapter, we're going to be covering the topic of inventories. So when we're dealing with a merchandising firm, they sell a product, and we're going to refer to that as inventory. So first of all, inventory is any item that the company holds for resale. So it's not any asset. It's a certain type of asset that the company is buying for the sole purpose of reselling. So if they buy Walmart, if they buy clothes, if they buy food, they're reselling that. But on the other hand, if Walmart buys a forklift or some other piece of equipment that they're using in their operations, they're not planning on reselling it, that would not be considered inventory for Walmart. However, the company that sold the forklift or the other equipment, that would be inventory for them because that is what they sell. So that's the key thing to keep in mind when we're talking about inventory. What is inventory for one company may not be inventory for another. It depends on what they're selling. So merchandise inventory includes all goods that a company owns and holds for sale, regardless of where the goods are located when inventory is counted. So what we're saying here is that companies are going to do a physical inventory count at least once a year, and that'll tell you what they have on hand, but that may not actually match up with what we want to report on the balance sheet as inventory. There may be some items that are not physically there to count, but they do own them. So we have goods in transit. If they own the product while it's en route, then they're still going to have to count that as part of their inventory, even though it's physically not there. On the other hand, if there's something that they're either holding for consignment or that they have consigned with someone else, these are products that, let's go with consignment. Consignment is when, let's say, Store A puts a product in Store B's store, so on their shelves. They make an arrangement with Store B. Store B is going to place that product on their shelves. They're not buying it. They're placing it on their shelves. If Store B sells it, if one of Store B's customers buys it, it's Store A's revenue because they own it, but Store B will get some sort of commission off of that, some sort of fee. So with Store A, even though they don't physically have it in their warehouse to count, they still own it, so they'll have to add it in, even though it's in Store B's store. On the other hand, Store B physically has it, so they can count it, but they shouldn't. It should not be considered their inventory because they don't own it. And goods damaged or obsolete. Here we're basically saying that we may have a product that is physically there, and we have it recorded at historical cost, but it may not be worth that anymore. It's maybe damaged. It may not be able to be sold at all. We'll talk more about this with the lower of cost or market later on. So going to our goods in transit discussion, we have what are referred to as FOB points, free on board. So when we look at this, we have to look at two things. First of all, inventory or any item that's being sold always moves from the seller to the buyer. And that's just logical. It's moving from the seller to the buyer. That's the flow of the inventory. For this FOB point to make sense, for the free on board point to make sense, we always have to look from the perspective of the buyer. FOB says this is free on board for the buyer until it hits a certain point. So if it's FOB shipping point, free on board shipping point, that means it's free on board for the buyer until pretty much right away, and right away when it hits the shipping point, which basically means it's not free on board at all because the buyer has to pay all the cost. On the other hand, FOB destination means that it's free on board until it hits the destination, which means it's free the whole way for the buyer. This FOB point also determines who owns the product at any point in time. This point is when ownership transfers. So in this case, it transfers to the buyer at the shipping point. So the whole trip, the buyer owns that product even though they physically don't have it. If it's FOB destination point, the ownership doesn't pass until the destination, which means that the seller owns it during the trip. The buyer doesn't own it until they physically possess it. So now let's talk about inventory cost itself. What all are we going to include in this cost that we're reporting on the balance sheet? Any expenditure we had to pay or incur to bring an item to a saleable condition and location. In other words, get it here and get it ready to sell. any expenditure we had to pay is going to be included. So the invoice cost itself, that's the obvious one. That's the price that we were charged for that inventory. But we're going to subtract out any discounts or allowances. We're going to add in any sort of taxes or import duties. Add in our shipping if we had to pay for it. Any storage that we had to pay, any insurance we had to pay. All those expenditures related to that inventory, getting it here and getting it ready to sell. We had to incur them. So now we go back to our physical count. I said that most companies take it at least once a year. Sometimes they do it quarterly, semi-annually, but all companies must take it at least once a year. Now, we're going to see perpetual and periodic inventory systems in just a bit, and these were talked about in an earlier section as well. Perpetual systems are those that where the inventory is tracked, it's updated into the inventory account right away when it's purchased, right away when it's sold. The inventory account should, all the way throughout the year, keep a good record of what is really in inventory at that point. Even with a company like that, we still need to do a physical count to make sure that what the computer says we have is really what we do have. And if not, then we have to make an adjustment to the merchandise inventory account. Keep in mind the physical inventory count itself needs to be adjusted for some of those things we talked about earlier. Those items where it's ours, we own it, but it's not here yet. It's en route. Those items that are on consignment that we own. So we'll have to adjust for those things. So now we're going to focus in on the perpetual system for now. And what we're going to say is we have two different types of inventory systems, perpetual or periodic. Perpetual, again, means it's updated all throughout the year. Periodic means that we keep track of purchases, but we don't put them into the inventory account until the end of the year. We reconcile everything to inventory at the end of the year. Throughout the year, we don't know what our inventory account really is. We don't have a good count. The only way we know is by taking that physical inventory and then adjusting for everything. For the costing methods, we're going to talk about 4 different types today: specific identification, FIFO, LIFO, and weighted average. FIFO is by far the most commonly used. LIFO is second. The one thing I'll mention with LIFO is that depending on how the United States, if and when we move to the international standards, LIFO may no longer be allowed. Current international standards do not allow it. So I would imagine most of those companies will move to FIFO. There are certain companies that use weighted average. These are companies that generally have high volatility in the prices. Fuel companies, for example, the prices jump, they go up and down. Weighted average, as we'll find, tends to smooth out those price changes a bit. So we're going to look at 3 of them here and see exactly what they mean. We said FIFO. That stands for first in, first out. The in and the out means into inventory and then out to cost of goods sold. So it's coming into inventory and staying there for a bit, then it's going out to cost of goods sold. LIFO, last in, first out. Last in to inventory, first out to cost of goods sold. So what we're talking about here, first of all, is unit prices. Which unit price is going in, which one's going out. So I like to use the example of a basket of apples, for example, or bucket of apples. So this store has purchased a few different buckets of apples over time. The price per unit has changed. So I'm just going to throw out some numbers. At the beginning of the year, the store bought a bucket of apples for 5 cents an apple. And then a month later, they bought another bucket for 7 cents. Another month later, they bought it for 10 cents. So in each of those buckets, there are only so many apples that you have at that original unit price. So no matter what, you can only use that quantity of each unit price. You can't just say, oh, we're going to take the first unit price and use 1 million of them, because if we only bought 100 of those apples at that unit price, that's the only number we can use. We can only use 100 of them at that particular unit price. The question is, which bucket do we dig into first to find out what unit price we're using? That's the ultimate question. The other thing I want to point out here is that there are 2 things. There is physical flow of inventory and then cost flow. So in physical flow, pretty much universally would be FIFO, first in, first out. What that means is that the store wants you as a customer to take the first product that was into their inventory, in other words, the oldest product, they want you to take that first. So that means that you're rotating their stock. You're taking the oldest stuff first. If we decided to take the newest stuff first, no one would ever dig back into the old inventory, and that old inventory would spoil. For example, milk. Milk is a great example. It's very perishable. Spoils within a couple weeks, few weeks. So let's say you go to the store, and the way it's faced, you have the newest milk down at the bottom of the shelf, so that's what you're going to be grabbing first. That's the oldest milk. It's been rotated to the front. If you decided instead to reach to the very back of that aisle, or the very back of that shelf, and grab the newer milk, you'd basically be using LIFO for physical flow. Now, that might be good for you as a customer. You get a few extra days out of your milk, but as a store, they're concerned that if people do that, the old milk is going to spoil. No one's ever going to want it. They're always going to pull new milk. So that's the concern there. Again, for physical flow, FIFO is almost always used. It really doesn't make sense to use anything else. But for cost flow, companies have choices. FIFO means that the oldest cost per unit is going to be used up first. And then that means the first one, the oldest cost per unit in there, is going to be the first one to be used. LIFO means the last unit cost, the most recent unit cost, is going to be the one that's used first. So we keep pulling from the newer unit costs. Weighted average smooths everything out. It assumes that costs flow at an average of all the costs available. So we'll see more detail on that in just a bit. Basically, we have to calculate a cost per unit average at that point. So inventory costing. What we have here is an example, two different sections. Here is our cost section, the cost of goods available for sale. This is what we purchased, what cost we had to incur, what price we paid as a store. Down here we have sales, which you'll notice the price per unit that we sell at is going to be higher than our cost. That makes sense. Otherwise, the company won't be able to last very long if they don't make a profit. These are often referred to as layers of inventory. So what we're saying here is on August 1st, we had beginning inventory that consisted of 10 units at $91 a piece, and here's the total. August 3rd, we had 15 more units at $106, and then you can see we have two different layers, different quantities, different prices. Prices are increasing in this example, which is the most common situation. It means that the economy is in a little bit of an inflation, which inflation is not necessarily a bad word. You want a little bit of inflation. That means your economy is growing. You don't want a lot of inflation because that means prices are going out of control and you have a lot of trouble there. But you do want a little bit of inflation. This example is an extreme amount of inflation because within 1 month, the price went from $91 to $119. That's a pretty extreme example. But it's that way to make a point, to show you the difference. You could have prices decreasing. That does happen from time to time. Prices are deflating. Not a big deal. So then here we have the retail sales of goods. Notice our selling price did jump up as well. So 130, then it jumped up to 150. One thing to keep in mind here is that a company generally sets their selling price based on what the cost is doing for them. Now, it doesn't mean they're going to change their price every time the cost jumps up, but from time to time they do need to adjust their selling price if the cost starts increasing more than they can handle. Otherwise, they're going to be eating that extra cost. So that's what we're seeing here. So we have 4 layers of inventory, and then we're going to have 2 different sales. Notice that this August 14th sale is right in the middle, and then August 31st is right at the end. So it's right between those 4 layers of inventory and then at the very end as well. So first let's go back to the specific identification. We didn't talk much about that. The reason is it's actually easy. When they're giving you a problem, they have to tell you exactly which layers each piece of inventory comes out of. There's no calculation per se needed. They tell you specifically where to pull it from. So here we have two layers, August 1st, August 3rd. Here's our quantity, our price, and our total balance. On August 14th, the company sold 8 bikes that originally cost $91. So they tell you 8 of these 10 bikes are going to be sold now. And then 12 bikes originally costing $106. So 12 of these 15 are now sold. So that gives us our 20 bikes. Remember, we sold 20 bikes here and then 23 bikes in the next layer. So to figure out the cost of goods sold, you take the number of bikes you did sell times the price that you're pulling. Again, they tell you where those came from. That gives you your total cost of goods sold. After that, you can figure out how much is left in ending inventory, the asset. You have the 2 bikes. Remember, we sold 8 of these 10, so we have 2 bikes at $91. And then we have 3 bikes out of this 15 at $106. So the total inventory there is going to be $500. Then we have our 2 additional layers. And then on August 31st, they sold 23 more bikes. And here's where those bikes came from. 2 at 91, 3 at 106. So that cleared out our first 2 layers. 15 of the 20 at 115. And then 3 of the 10 at 119. So you can add up all your cost of goods sold figures there for that period. Now what we have here is an illustration showing all the different entries we would have for those sales, for those purchases and sales. So on August 3rd we made a purchase. Here's our inventory entry at cost. On August 14th we had a sale. So we'd have that 2-pronged entry. The first part would be handling the sales itself, the selling price, debit to accounts receivable, credit to sales. The second part would be handling the cost of the inventory, debit to cost of goods sold, credit to merchandise inventory for $2,000. August 17th, August 28th, we had 2 more purchases. August 31st, we had another sale. So this is all based on the information that was given to us earlier. The key thing I want to point out are these items in red. This is the cost entry, and it's going to change under each of our 4 methods. We'll see a summary of that at the very end. So now let's talk about FIFO. We have our first 2 layers again, and then on August 14th we sold 20 bikes just like we did earlier. The question is, where do we pull those 20 bikes from? They don't tell us because it's FIFO. We have to determine which layer to use up. So since it's FIFO, we're going to use the first layer first. So our first layer, our oldest layer, is the 10 units at $91. We want to sell 20 bikes. We can't pull them all at $91 because we only have 10 of them at $91. So we're going to clear out this layer. We're going to use up this 10 units at $91. And we have 10 more we need to use up, so we pull them out of the next layer. That's all that's left. So 10 units is going to be 91, and then the other 10 will be 106. That tells us we have 5 left at $106 in ending inventory at this point. 5 units at 106, that's 530 in ending inventory. And our total cost of goods sold, you can add it together to get $1970. We have our 2 additional purchases, and then on August 31st we sell 23 more bikes. So again, we have to figure out where do these 23 come from. With FIFO, the key thing is, what is the first layer at that point? At the point of that sale, what is the first layer that we have? We used up the August 1st layer, so that's gone. We only have 5 left at the August 3rd layer, so that's what we're going to start with. That is the first layer at this point. We're going to take 5 of them at 106. And then we need 18 more to get to 23 total. So we move to the next layer, which it gives us 20, so we have plenty. We pull 5 out of this 106 and the remaining 18 out of this $115 layer. That gives us our cost of goods sold. And we know we have 2 left in this layer and all 10 left in this layer for ending inventory. This particular example was just giving you an inventory balance. It was keeping a running total along the way, so that's fine as well. Notice the cost entries changed from the last method. We'll see a summary at the very end. So let's go through LIFO, last in, first out. So we still have our two layers here. We're still selling 20 bikes, but now we're using LIFO, so we want to go with the last layer available at this point. But we only have 15 there, so we use 15 of those up at 106. Then we have to dig into this earliest layer to get the remaining 5 at $91. Again, we can add up our cost of goods sold. What is left at this point for ending inventory is 5 units at $91. Keep that in mind. Now we purchase 2 more layers, and we want to sell 23 bikes. So last LIFO, we want to use the last layer available at that point, which is now August 28th. So we get 10 of our bikes at that, and the additional 13 at our August 17th layer of $115. Guess what? We still have some in August 17th layer, and we never did touch the August 1st layer again. That's left back there. That is one of the issues we'll see with LIFO. If we continue to buy more and more inventory, we may never get back into our oldest layers. We may have these really low prices compared with the newer prices, and we may never be able to get back into them. We'll talk more about that topic in just a second, just a few minutes here. So again, our summary, here are all the cost of goods sold figures and our balance sheet inventory. The different cost figure here for both of them. So now we move on to weighted average. This one requires a little bit of a calculation, but once you understand it, it's actually one of the easier methods because it compresses the layers. You don't have to keep track of tens and dozens of layers. You kind of compress them each time a sale is made. So when a unit is sold, when we're about to do the selling entry, we take a look at the average cost of each unit at that point. To get that average cost, we take all the cost of goods available for sale out of every single layer, add them all together, and divide it by the total number of units on hand at that point out of all layers. That gives you an average cost per unit. Basically, at that point, we're compressing all of those layers into one, an average layer. So again, to get this average, we take a look at the cost of goods available for sale, which here, that's our inventory balance. They've kept track of this along the way. So it's $2,500 inventory divided by 25 units in inventory, 10 plus 15, 25. That gives us that gives us $100 per unit on average. So now both these layers have been compressed into a 25 unit layer at $100 average. So now we're selling 20 of those bikes. So at what's left, 20 at $100, that's our cost of goods sold of $2,000 for that sale. And then what's left is 5 units in that average $100 layer for $500 total. So even though they didn't add in a layer here, if you were doing this on Excel or by hand, you would probably just want to cross out these 2 layers and just change them to a new layer. You can call it an average layer. But in any case, August 17th and 28th, we bought 2 new layers of inventory. So what we're going to have to do is, now that we're making a sale on August 31st, we're going to have to merge our average layer plus these 2 new layers to get a new average layer. So we'll calculate a new weighted average cost per unit. So at this point, we've been keeping track of our inventory. We have a total cost of $39.90 divided by 35 units. 20 plus 10 plus we had 5 left from these earlier layers. $39.90 divided by 35 units gives us a $114 weighted average cost per unit. So we're selling 23 of them at that cost. That gives us $26.22. What's left is going to be 12 units at that $114 weighted average cost. And this is just a summary of our cost of goods sold in our balance sheet inventory balance. And again, here is the summary of what this entry looks like now. The cost changed yet again. So what we have here is a summary of everything, the total cost of goods sold under each of those methods. Again, notice how they're changing. And then we have the balance sheet inventory, which has also changed. The one key thing to note is that under any method, the cost of goods sold and balance sheet inventory, which gives us cost of goods available for sale, that's going to be the same under all four methods. So we're always going to have the same total cost of goods available for sale. The question is where did we move them to? Did we move them out to cost of goods sold, or are they left in balance sheet inventory?